What is aggregate demand? Aggregate demand is the total amount of goods and services demanded in an economy during a given period. Who demands aggregate output? Consumers, firms, government sector, and foreign individuals. AD is equal to C plus I plus G plus NX. Consumers demand to satisfy their needs. Firms, they demand to make investment. Government sector demand to run an economy. And foreigners, the consumers in the foreign country who demand our domestic output for the satisfaction of their wants. From this, you subtract the amount of foreign produced goods and services demanded by domestic individuals known as imports. As you can see, AD curve is downward sloping. At higher price level, less amount of national output is demanded. At lower price level, higher amount of national output is demanded. The question is, why is AD curve downward sloping? There are several effects. First is the wealth effect. Suppose P is the price level in the economy and W is the nominal wealth you have. Further, suppose P falls. This will lead to an increase in W by P. Amount of goods and services you can buy from your wealth will rise because price level has fallen. Your consumption will increase. Hence, aggregate demand will increase. Hence, in this case, when price level has fallen, aggregate demand has increased. Interest rate effect. Suppose price level falls. Real value of consumers' money holdings will increase. When they buy same amount of goods and services as they were buying before the price change, they will have more money left with them. They will purchase bonds with this extra cash. This purchase of bonds with this extra cash will lead to fall in interest rates on bonds. Because interest rate has fallen, this will lead to increase in investment. When investment increases, aggregate demand will increase. Hence, in this case also, when price level has fallen, the level of aggregate demand has increased. Exchange rate effect. When price has fallen, interest has fallen. You've seen this earlier. When price level has fallen, interest rate has fallen. This you have seen in the interest rate effect. In general, when price has fallen, domestic interest rates has fallen, then these domestic interest rates, they fall as compared to the foreign interest rates level. Domestic interest rates, they are lesser as compared to the foreign interest rate level. Let me repeat this. When price level has fallen, interest rates decreased. This you have seen earlier. In general, what is happening is that in domestic economy, domestic interest rates have fallen. So if you compare this with the foreign economy, what you will find is that domestic interest rates, they are lesser than foreign interest rate. As an investor, what will you do? You will invest in which market? Domestic market or foreign market? You will invest in a market which will fetch you a higher return. Hence, investors, both domestic and foreign, they will invest in foreign markets because of higher returns on foreign assets. Capital will flow out of the domestic economy because domestic investors are also investing in foreign assets and foreign investors are also investing in foreign assets. So capital will outflow. Capital will flow out of the domestic economy. There will be depreciation of domestic currency. A unit of foreign currency is worth more than a unit of domestic currency in this case. A unit of foreign currency can buy more amount of goods and services than before a price fall. Hence exports will increase. Because foreigners, now they can buy more amount of goods and services of the domestic output before as compared to a situation before the price fall. This would mean that exports are increasing. Similarly, a unit of domestic currency can buy less of foreign goods and services as compared to a situation before the price fall. This will lead to fall in imports. Exports are increasing, imports are falling. So net exports will increase. Hence aggregate demand will increase. So even in this case, what you have seen is that when price level has fallen, aggregate demand has increased. So in general, this is the reason when general price level is less, there is more demand for the national output, and hence AD curve is downward sloping.